as a carry trade. I think he has a basket of Swiss franc trades. I don't hate those at all. I like that idea a lot. Just, positive carry and kind of trading over extended levels can work well, but you have to, again, and people who do this like Chris, they know very well how important it is to position size appropriately and accept that you're going to have swings both directions. You're going to have things go in your favor, against you, so on and so forth. Silver's up 1% today, got gold up 0.7%. What I'm looking for on gold on a daily chart perspective is I'd like to see if today we can close strongly above this previous level of what was resistance. I was in a long position right here, went in my favor, did not do anything with it, and ended up getting stopped out. So what I'd like to see from a technical perspective, and my memory is fresh on this one, I'd like to see this previous level that we failed out. I'd like to see that one break. Right, show me some strength at these areas. Then I might be willing to try again. And this one is actually a live setup for me because the Edge Finder is giving me a bullish reading on gold right now. So I really like that. The Russell is also giving me a bullish reading. So maybe if we get some pullbacks, but look at this chart, man. The Russell is just looking clean. You've got this level here. Looks like the classic kind of bull flag pattern. Even a little bit of a triangle here, right? You've just got the perfect setup for what looks like it might pop, right? But again, nobody's knowing for sure what's going to happen with the Federal Reserve today. I don't know what he's going to say in his press conference, but a pullback, I lean bullish on maybe picking up the Russell. Also, so I've got several things. I'm watching Russell for pullbacks. I'm already long the Dow. I'm long the Nas. I'm looking for gold pullbacks or breakouts, right? Breaks and retests would be good. Oil is crazy strong today. We'll see where that goes, but no setup for me on oil. Dollar yen, another really interesting one, down 1.3% today. The yen has just been very, very strong today. So should be interesting. Guys, we got Chris Pulver joining the show here in just a moment. So we're going to take just a quick break to thank our sponsors. Remember also at the same time, if you haven't already gotten a copy of the Edge Finder, it is currently 55% off. We'll drop that link one more time. Don't miss out on that sale. Should also be pinned at the top of the live chat. So with that said, we'll be right back with Chris Pulver to talk more charts as we gear up for the Fed meeting. Stay tuned. All right, and we're back with Chris. Chris, part two for both of us now. We've this is the second run back on the A1 Trading Show. We've been live all day long, and you're back to help us carry to the finish line. What's going on, man?
Well, nearing the all-time highs again in the portfolio, which is nice to see, and closed out for some profit. So I just had a little watch list this morning. So took some profit on the QQQ. I had I think on my screen, I think I've got my screen shared. So I was a little bit conservative. So I went ahead and took some profit when we were poking up here towards 470 and change. I had a 474 call that was an out of the money call when price was trading on Monday around 462. So that was not a expensive option, but I was up around 15% on my position. I thought better safe than sorry for a couple of reasons. The last 2 weeks, Nick, we've had some ridiculous moves in the Qs where the average has been around $13 a week. The last 2 weeks has blown that up, and so this 2 weeks ago. We're talking about a QQQ that moved around $27 from high to low. Last week, the movement was, I think, a little bit bigger than that at $28 and change high to low. And this week, after our Tuesday low, we've already gone up around $16 or $17. So we're up $17 from low to high. Now, I could sit here and say, I think it's going to go up to this gap and it's going to fill this gap. But if it doesn't happen in the next 2 days, that call option for me is worthless. So I took the profit. I got in the debit at like 295. I closed it out for 365 today. Took the profit. I've got some bull put spreads. They're looking pretty good. As long as price stays above 460 for the week, I make some money there. As long as the IWM stays above 218 for the week, I make some money there. I've got a good looking trade on Pfizer that if Pfizer stays above $30.50 this week, that's going to make me about 17 grand. So all in all, I just did some some management in between sessions, and I closed up some profits, protected some trades. I do actually, I think we talked about this yesterday on the show. I own some shares of Google right now.
Hey, nice.
Not bad. Now, I don't have to do anything at this time other than just chillax and see what the assessment is for later in the week. So if I go to GOOGL right here.
Also, Chris, just to note
Yeah.
for people listening on Google, Meta reports after the bell, which will probably move Google as well.
Yep.
Meta's earnings, we can't forget, you got the big Fed meeting today, but Meta for stock traders will also be huge. Ad spending, the AI trade. I mean, Meta is another bombshell, just like Microsoft was. So we'll see. Just wanted to mention that, but keep going.
No, it's true. Meta is going to be important to watch today. So the reason I'm not closing out my position or taking the shares of Google is because just in case we do have a drop to the downside, I'm still protected with a 187.50 long put. So here's what happens. If price on Google at 170.40, if we're down below 170 by the end of this week, I will make $1.75 per contract on that bear call spread. So I have some profit potential right there that I'm going to sit on for right now. I was assigned at the 190 and I was assigned early, but the good thing is I still have my 187.50 long put. So if price goes down, I actually have profit on the 170 bear call spread. I would still hedge with my 187.50. And Nick, I think I'm willing to own the shares and then repair it. So I'm not necessarily looking for like a long-term hold on Google, but we've already had a bit of a haircut off these tops.
I was
So
just about to
Google,
say, Chris, you telling me that is interesting because it is
yeah,
a dynamic shift. I feel like if I was employing kind of more approaches like you with individual equity names
mhm,
2 weeks ago or 3 weeks ago, I would have wanted to avoid assignment like the plague. But now with the Nasdaq, seeing a 10% drop, maybe you have a little bit more willingness to take on some positions because. I was looking at Google myself. Like, do I want to buy some shares and just stick it into the account and just wait on Google?
yep,
I mean, I had one other one that I think is a fun one to look at. I don't know if I want to buy it yet, but CrowdStrike, which has gotten absolutely
yeah, beat up a
ripped
lot from
apart,
that global breach, right? The data breach.
42% drawdown
Ooh,
in like
baby.
2 weeks. I mean, or 3 weeks, I guess. But
Yeah.
I've been super bullish on that space, the cybersecurity space, for some time because
Mhm.
I really like the, just with all the AI stuff that's coming, I like it. But timing on this one is tricky and also very important because look at this. This is clearly a broken chart. If you take a look at like just apply some moving averages here,
Mhm.
look how we blew through everything, right?
Yep.
The 20, the 50, the 100 day, the 200 day, everything completely did not hold one bit. It tried here just briefly, and then lawsuits came out, and CrowdStrike is in free fall. But here's a company that has really outperformed the S&P 500. It's a leader in the software space. Not so much leading the S&P 500 now with that ginormous drop. We're back to 2021 levels, but just worth mentioning, there are some stocks out here getting pummeled. And so, as you mentioned, stocks taking a bit of a breather here recently, not today, but in the last few weeks. Um, Maybe some willingness to own some stuff. I've bought this dip more than once. I've been early to the dip, so we'll see if this ends up being the bottom today, or if this has the potential to go anywhere today, Chris, for the rest of the day.
Yeah, I mean, we have huge gaps today, right? I mean, this is a monster gap to the upside on the Qs, monster gap to the upside on the SPY. We're likely not going to fill the gap today, just based on certain percentages with a 1+% gap or 1.5% gap. It's rare we're going to come all the way back and fill the gap. The one thing that I note here on the S&P or the Qs, the Qs poked the lows. Which tells me that we're likely also not coming back to retest the high of last week. So like I said, that's a big number to go all the way up and have a $28 down week and then somehow come right back and have a $28 up week. If that happens, Nick, that is a pretty wild amount of volatility for July. I mean, we're
Oh
talking
yeah.
summer trading, lower volume, and this thing's having some, 1.5 to 2 standard deviation moves. We're well above the norm of what we expect on a week to week basis. So anyway, I mean, I think that the good thing is we kind of stabilized that 10% correction right there with that Tuesday low, having a big gap to the upside today. A lot of that is credit to AMD, credit to Microsoft, with decent earnings. I know Frank is in the background trading some Microsoft earnings, and I think I disappointed him a little bit by giving him some reality. He was like, Microsoft needs to move about 16%. I'm like, I think the earnings moves on average about 4%. He's like, well, now you tell me.
Yeah,
So,
Microsoft, I mean, it was looking crazy bearish right off
yeah.
the rip. And then it just snapped back. I was, to be honest, by this move so far today, Chris, I've been a little bit shocked by it in terms of like the Qs because, I see the AMD story and semiconductors are up huge today. But then Microsoft's like cloud spending or cloud growth was disappointing, and takes a little bit of the air out of the AI trade. But
Yeah.
I don't know, man. It's there's just so much still to go this week. It's really hard to say if today's move is real, if it's going to last, or if it's going to go much further from where it was. I mean, the Nasdaq could be up 3.5, could be 4% up today. It could be down, or not, maybe not down like you mentioned. Very unlikely for that, but it could be,
Right.
could be down from where it's at now pretty easily if the Fed disappoints in any way. And I want to just talk, because we're getting closer here to the statement. We've got about 15 minutes. What are you looking for out of this this Fed meeting? I know very unlikely that they cut interest rates, but
Yep.
this is all about kind of shaping up for September, right?
Definitely. I think it's important that Powell kind of reiterates what he did last month, which is, I think last month was a pretty dovish tilt when he said, and I'll paraphrase here, but basically said, we don't need inflation to get down to 2% or lower for us to start cutting. Because if he said, if we're already at 2%, we've kind of overshot it. And so that was really the first time that he's hinted towards, like, we're ready to cut, we're willing to cut. And the market is kind of calling the bluff too. It's like, we've heard the Fed talk out of both sides of their mouth for a year plus, right?
Mm-hmm.
If inflation's bad and it persists, we'll be restrictive. But your best measurement of restrictive rates is going to be your core PCE, okay, versus your Fed funds rate. That's going to be what's restrictive. So right now, the core PCE, what's that on the Edge Finder, Nick? Do we have core PCE? I know we have
No,
CPI
but I
data.
believe it's 2.6.
Okay.
I
So
think it's
right
2.6.
there, it's like we're talking about, 5.25, 5.5% versus a 2.6. That's restrictive. We can bring the Fed funds rate down to probably, 50 to 100 basis points above the core PCE, which is also trending lower, like CPI is trending lower. And so I just think that the markets kind of sniffed it out, and the markets made a move. I mean, I think that's where we had those, 6 or 7 days of all-time highs in the S&P and the Qs, and that was a bit like frothy. And so I also wonder, it's like, okay, we're going to cut in September. I think it's going to happen. The probability on the watch tool is really high. That rarely goes from 90+% and then is wrong. But we still have all of August. We still have Jackson Hole. The only thing that would be a surprise to me right now would be if we have some bigger geopolitical event in August that kind of shakes things up with Jackson Hole, and it'd have to be like a geopolitical risk as opposed to, I think the Fed's going to cut. I think the Fed's going to cut September. At this point, I don't think they care whether it's Trump or Harris as a president. I think the Fed's going to cut in November, 2 days after the election, which at first I thought that's crazy. But now I don't think the election is as big of a deal. I think that,
I agree.
Trump Biden was like, everyone's pissed about Trump Biden. It's a terrible election anyway. I'm not saying that Harris and Trump's any better, but I just think at the end of the day, there's not really a policy surprise by either candidate. If it's Kamala Harris, it's going to be more of the same, um, and that's not terrible. Or maybe it is. I don't know. That's a matter of opinion. But for Trump, it's like, I don't think Trump has necessarily this big shift in policy unless he really wants to touch on the geopolitical risk. Because if Trump wants to get into tariffs and we have a trade war again or a tariff war again, guess what? That's not good for a lot. That's not good for global economy. That's not good for growth. That could actually be a handcuff to, we can talk about cutting the corporate tax rate, but if we go into a full-on trade war, none of that's going to be good, man. So I just think the market's like, okay, maybe there's some election drama later on, but right now it's like polls are mixed, or what are they? Everyone's in the 40s right now. It's like there's no real clear winner. The majority's been kind of pulled back from Trump a little bit. But that's November, right? I think the Fed
Yeah,
still cuts in November. I think they're going to cut
I
September,
think so
November,
too.
December,
I
and
think
they'll
they're
do
going to cut.
exactly what they said, which is 3 cuts. And they said that
Yeah,
back
I think they're
in
gonna. I think they're
January.
gonna cut because the the word that or the way Powell has phrased it several times is that, you know, we don't make our decisions based on politics. He's been
Yep.
very, very aggressively firm on that
Yep.
topic. So I think if he were to kind of solidly stake his point by cutting interest rates right around the election, because that's what the data is saying, and you know, that might also be another thing that he's thinking about today is almost like a counterpoint to that. So think about this, Chris. So today, if you're Powell and you're like, oh man, I'm going to get in so much trouble if I cut for the first time right before the thing, we need to get one rate cut in.
Right.
If anything, he's going to do the opposite of it being a political move. He's going to try and make it look like less of a political move by maybe cutting September for the first time and solidly staking like, hey, we're going to cut interest rates 3 times the rest of this year. That way it doesn't look weird that the first cut happens in November. So I don't know. That's if you want to really play that game, you could make the stake that he's not going to do it politically. He's going to do it counter to look counter. You know, I don't know what the word
That
is
is
now.
already premeditated. Like it doesn't.
Yeah,
The
like we're going to
election
do it
doesn't
anyways.
matter. We're going to do it regardless. So
Yep.
deal with it. Like we said we're going to do it. It's time to start. We think it's appropriate. So yeah, I mean, based on the press conference, I would like to see Powell just stand firm on his. Like we've gotten this far, you know, with the back and forth in the Fed. It'd be nice
Mm-hmm.
to see Powell just kind of stand firm and say we think it's
I think so too.
appropriate. We don't need inflation to be down to 2% to start cutting. You know, we've been watching the labor market. We've been watching this. Inflation's trending lower. Blah 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 blah. You know, all the points. And then as far as the I mean, if somebody were to ask, I've mentioned this in my trading room. If somebody was asking, you know, Powell for Q&A today about the election, and it's like he can just say the same thing. It's like, you know, our decisions are not based on who's president, who's going to be in politics, what policy is.
They're
You know,
probably
our
going to ask
decisions are
him
based on
today, Chris. They're
our
probably
best
going to
interest.
ask him in 10 or in 30 minutes from now. They're going to ask him, are you going to, in regards to the November meeting? And he's
Correct.
probably going to say the exact same thing that we're
Yep.
talking about. He's going to sound not political. I want to thank really quick, Raul in the chat. Thank you so much for the 20 on the donation there. Appreciate you. 20 rupees. Thanks so much. We really appreciate it. That's going right towards the trading accounts. We'll place a bet for you. Just kidding. But yeah, anyways, thank you. Yeah, I mean, Chris, yeah, it's going to be interesting because I think that that's actually a solid idea of they're going to premeditate. That's a great way of putting it. Premeditate that they
Yep.
already had planned, as they said at the beginning of this year. I mean, if they get it right and the whole market got it wrong, that's just going to show how good they are at what they do and how absolutely emotional the stock market actually is, right? Because if they
Sure.
actually come out and deliver 3 cuts as they predicted in January, when the whole market was so absolutely gun ho about rate cuts, thinking we'd see 6, I mean, it just shows that they're the professionals. And you know, I made the comparison recently, and I'll say it again for maybe people who missed this concept. The idea being that, you know, if you're really good at sports betting, the casinos will hire you to help write the lines so that they can better price and make more money themselves. In economics, the same pinnacle of economics is working for the Fed as like a very high up, you know, hedge fund, a very high up hedge fund, or at the Fed using your super skills with economic data to try and forecast better. So they have some really smart people at the Fed. I mean, they've got some geniuses over there in the economics data, and they still get it wrong. So, you know, that's just how hard this stuff really is, Chris.
Yeah, and I will say I'm going to give, you know, a little bit of shout out to Jerome Powell and the Fed simply because the language and the transparency and the consistency has been pretty much tip top. You know, this
Yep.
is you can't fault Powell for being the same guy every single month. And sometimes the market likes it, sometimes the market hates it, sometimes the market's so confused that they get nothing out of him. But month after month, when we do sessions like this and we're dissecting his statement and we're dissecting the Q&A and we're looking at what the Fed meetings minutes are reading or posting, the consensus has pretty much been consistent every single month. And to a fault, it's been like, okay, we get it, man. It's the same thing. They might raise rates, they might not raise rates. But as we get closer to wrapping up the summer, getting back into September with the high probability of that rate cut coming, I think at this point, I think the Fed's in a good spot where it's interesting, Nick, like the consumer has kind of seen enough damage where the unemployment's gone up. We've seen spending cut back quite a bit. Delinquencies are starting to happen in the background. It's like I think that the Fed might get it right, man. Like, I mean, I think that in historical sense, the Fed has backstopped a lot of crisis, right? And that's
Yep.
been, the greatest thing ever if you have the assets to buy, or you are, if you have the dry powder to buy when we've had a crisis. If you bought in 2001, you bought in 2008, you bought in 2020, you're killing it, right? That's been the Fed backstop that's worked for many, many years. The saying is don't fight the Fed. It's not really any different now. You just got to wonder if at some point, the Fed doesn't have the backstopping power to then halt the market and then see all-time highs again. At some point, maybe the backstopping is it gets worse, it gets nastier. We have another 20, 30, 40% correction off these all-time highs. And I think that's the scary thing is you never know. But
Yeah.
I don't try to trade like, oh, the black swan is the only thing I'm focused on. I'm certainly not overly bearish. I'm also at this point, we've had a great run for the first half of the year. I'm not overly bullish either. I think having a 15 to 16% gain year to date is pretty darn good, man. I mean, if we
Yeah.
stretched 20%,
Well, you're kind
a
of, Chris,
hell of a year on the indexes.
correct me if I'm wrong, but you're kind of in the camp of not necessarily outright, black swan bear, but also not, melt up either. You're kind of in like the looking for yield camp right now. Cause I've seen you doing a lot of stuff where you're just collecting positive credit, and kind of trading with a directionless, ultimate bias. Whereas I lean more on the bearish side. I mean, on the bullish side. I've kind of let go a little bit of my willingness to only touch gold, because I think that the tech trade is alive and well. I've been annoyingly persistent on that recently, but I think that you made a good point there too. It's not about the elections this year. I think, as you kind of gave a nod to Jerome Powell, he might just be the guy. He might be the guy, Chris, that can do another 1995 soft landing. And maybe
Yeah.
we're underestimating him again, as we have for, many people have for a number of years now. He did make the mistake with the transitory inflation thing, but supply side inflation is inherently very difficult for the Fed to predict, right? The world shut down. That's really hard to predict what's going to happen with inflation.
Yep.
So, maybe he's just that guy. I don't know. Also, just real quick, another donation in the chat. Guys, stop donating. I appreciate it. But if you want to purchase anything, get coaching with Chris or come join our membership group. You get a lot more value out of it. We do appreciate the donations. Thank you so much for supporting what we're trying to do here. We got Fed meeting coming up in 5 minutes. We'll have that loaded up on the screen. I'm sure the stream team Powerhouse will get us set up with that. But Chris, I wanted to give you a chance to respond to that because I just ranted. But is that where you're kind of leaning? You're more on the yield collection, a little less bias one way or the other, or do you have a bias?
I'm just trading, dude. So if I went through my entire portfolio right now with my positions, they're tilted bullish because that's inherently what the markets tend to do.
Yep.
Oil, I'm bullish. E-mini. So this is the E-mini S&P. I've got the E-mini NASDAQ, the E-mini Russell. So basically just trading futures markets, but I'm staying out of the way. I have, bear traps. If we have a fall by anywhere between 10 to 15%, I do have a couple black swans that are, I mean, percentage wise, probably a 0.5% hedge that would pay upwards of like 10% protection, close to it.
You also
So,
got
I
a
mean,
big
so
position in
there's,
Bitcoin.
what's that?
You got a big position in Bitcoin, right?
I do. Yep. So I'm bullish on Bitcoin, and that's more like, dollar cost averaging. I've got about a 3% stake in Bitcoin, about a 3% stake in gold, about a 3% stake in silver. I have about a 3% stake in China. So I've got some non-diversification. I've got some puts. I've got some, credit spreads. I've got some ownership. I'm all over the place, man. And I'm not saying that it's like this guy can't figure out what he's trading. It's like I've got a reason for everything that I'm in.
No, and
But it's
diversification
all over
is
the
a
place.
strategy.
Yeah, of course.
Here I am. I'm very narrow,
Yep.
but that's a strategy that I'm kind of focusing on. But you're taking a diverse approach.
Yep.
I think I will probably slowly join you. If the market melts up again, I will slowly join you more again. A couple months back before this dip, I was super all over the place. I had a good mix of everything. Then when the dip happened, I have narrowed back into tech again. But it's trading what you're seeing, trading what's in front of us, and I do have a bit of Dow in my portfolio. That's actually one of the better performers right now. Is just the Dow Jones, which is more defensive in nature, more a dividend stock, more value stock based, blue chips. I've got the NAS in my account, so we'll see. But diversification, having many different things going on at the same time is absolutely a strategy, especially if you think that the market is not just going to straight melt up. Diversification typically outperforms when a market isn't going, straight parabolic up. And we certainly have seen an increase in volatility. Got another donation. Thank you so much for the 20 rupees. Our friends in India are really dropping the rupees in the house. So thank you very much, guys, for the donations.
Let me get a question out of you, Nick.
Yeah.
Tesla. So same thing that happened to me on Google. Tesla did the same thing. So I had some in the money credit spreads, both on the put side and call side. I was assigned Tesla at 270. Okay. And I have a 267.50 running for a long put. So I'll show you what position is right here. If you can't see my numbers, here's my my assignment was 272.50. My put is at 270. So right now I have a put that I could probably close out for about $40. This is out to Friday. So if I close this position, I could close out for about 39 of the $40. The reason I'm not doing anything on this right now is I still have a bear call spread at the 230 by 232.50. So if Tesla is down below 230 this week, this becomes full profit. So if I close this out for full profit, this should be $1.75, and I'll take that profit. I could also look for repair on Tesla. Now, this is a stock that has been volatile, and I understand that. I have some ratio spreads down here. I don't necessarily want to take on more shares of Tesla, but for the, let's say, next week, if I did a assignment, I'll calculate my break even. If I own it at 272.50, it's going to be something to this this effect. So 272.50 minus $1.75. Let's say right now that I close out my put at $40. Well, I'd own the shares at 230.75. We're trading right around $230. We're trading about $230. What I want to look at next week, Nick, is if I went out to next Friday, the 9th, and I sold an at the money call, I could collect $7 on Tesla for a covered call. So I could own the shares at 230, lower my cost basis all the way down to 22 and change. If price stays where it is, I'll make $7 a share on Tesla.
Yeah.
That's an easy repair for me. This is a high premium stock, even though
totally
it's a low IV. Like for Tesla, it's a low IV environment. But man, getting $6 or $7 out 1 week, dude, that's crazy.
No, it's insane. Chris, that was one of my first when I first started dabbling in options. I had a position in Tesla from 2020 lows. I mean, I had a perfect one. And I actually got called away after selling calls several times on Tesla. I finally got called away before all the big drop. I played Tesla accidentally perfectly with options. And I remember being like, dang, I got called away. This kind of sucks. And then that ended up being a beautiful, thing. And the premiums I remember were just ridiculous on Tesla. So it is a
for sure
very interesting one to watch. Chris, we got the Fed meeting here starting in just a few moments. I'm not gonna make you stick around and wait because we're probably just going to let the audio play. So before that gets started, let me just let everyone know that if you guys enjoyed listening to Chris's commentary, Chris is a regular contributor to the A1 Trading Show. At this point, he's practically a host on here all the time. So if you enjoyed Chris's commentary, let me just give a quick shout out to him. He's got his social medias. We'll drop the links here in the chat. You can find him on YouTube. You can find him on Twitter at Real Chris Pulver. And also, Chris does offer a free Discord channel, and he's got some coaching that he does. He does on one-on-one stuff. So if you're looking for any of that, if any of that would be useful to you, take 2 seconds. Make sure to go subscribe and get going there. We have Fed. Am I missing something? Do we have?
Should just be the decision that just came out. It's going to be a pause. Nothing crazy. I'm just watching some oscillations in the S&P, but I don't see anything changed. It came out as expected. 5.25, 5.5.
Okay, so I said that wrong. So we got a little bit of time before.
30 minutes for the press conference. Yeah.
Okay. Yeah. So guys, to anybody who was really hopeful for that very 4% chance that we'd get the cut today, we didn't quite get it, but maybe next time. No, but probably still on paper for a September cut. Also, this morning, Chris, I was looking through some of the recent data. We had ADP this morning came in a little bit light. The employment cost index came in a little bit light. There's just been a consistent theme of economic data coming in cool. And I think that supports really solidly between now and then. If you keep seeing stuff like that, a September cut, but also to your point about November, I think like November is the question one, because I think December they probably will cut because it's definitely not going to be considered as political then.
Right.
But I think November is still very much a possibility if you continue to see the data rolling in light. It's almost like September. It's weird how far this market looks ahead. But you got to think it's like this market's thinking, okay, September's on lock almost certainly, But then the question is November on? That's the real question.
Yeah. Well, what's weird is, typically the FOMC has always been like the third Wednesday of the month, and it's been all over the place these last couple of years. Like sometimes we have it, first of the month, sometimes we have it end of the month, sometimes we have it right after CPI prints in the same week. That's been the difference for me is the FOMC is not the consistent. It's always the third Wednesday, whether it's FOMC
Yep.
median minutes or if it's the actual FOMC statement and press conference. I'm just looking at some real time news right here. So we see inflation remains somewhat elevated. Fed repeats does not expect it will be appropriate to lower rates until it has gained greater confidence inflation is moving sustainably towards 2%. Attentive to risks on both sides dual mandate. The change from June was when it said it was highly attentive to inflation risks. Short-term interest rates, future slips on FOMC decision. Traders slightly pair bets on Fed rate cuts. Also, the same thing I just said about the FOMC when it's time this go around. November it's 2 days after the election. That's crazy to me that even popped up on the radar. Like, oh yeah, the Fed might cut 2 days after the election. It's hard to look at that and say that's not political, but it is. I mean, it's very much in the news of everything that's going on during that week. It's going to be a crazy week as it is. I'm wondering if the markets even care. I would assume that they do, but maybe they don't, man. Because if we have Harris or Trump and we have some type of gridlock between the House and Senate, markets like gridlock. Markets like nothing. Markets like the same old, same old. They want the certainty. So unless we have like a sweeping Republican
I saw
side or
some
a sweeping
stat that was
Democrat,
interesting,
not going
Chris.
to
That
matter.
was like the market historically does very well when you have a Democrat president and a Republican Senate. And it was like, whoa, that's really interesting. It's almost like when there is not a whole lot of dominance, it actually is better for the stock market. Because at the end of the day, I mean, let's face it, it's all about the Fed. Are they printing money into the system, injecting stimulus, or are they not? And that is why, people will spend all day long, oh, the economy will be better under so and so and so. But you look at the long-term historical averages of the stock market under a Republican or Democrat, it's pretty dang similar. It's pretty dang close. The bigger question is what the Fed's doing. And for me, it's like if Trump does get in, I would hope that he chooses to keep Powell in the seat so long as he continues to do the job he's been doing. Because let's face it, I mean, the odds for a soft landing right now look pretty good. I mean, the economy doesn't look like it's under serious jeopardy. It is slowing, but it's not crashing. I mean, you got inflation normalizing. I was going through this earlier today, but you've got inflation back in a trend lower. You've got the economic growth. We saw 2.8 advanced GDP, which was what the Atlanta Fed now GDP now, what that forecast was very, very, I think they were forecast for 2.7. So 2.8, stronger than expected growth. You got inflation cooling. And the further we get from that 2020 supply side shock that we saw, and we can see inflation kind of coming down while growth is still sustained. I mean, I'm kind of leaning towards the soft landing camp, and maybe we're looking like 1995, but it scares me to say that because the second you think it's 1995 again, where we saw growth really expand and inflation normalize, that is the sweet spot for stock market gains. And so that's the question: are we going to see something similar to that, or are we going to see more of a 1999, 2000 where problems arose? So we'll see. Actually, more 2008, right? Economic slowdown would be the question. Do you think the economy?
And the thing that's uncertain would be potentially the stagflation, right? It's like if we see like stubborn or sticky inflation plus things slow down, that stagflation is what the threat was, and that's why everyone thought we're going to have a recession in 2022. Inflation is trending lower. The consumer stayed relatively resilient despite ticks up in unemployment, which I don't think are necessarily gonna stop. I mean, if you look at the jobs numbers and where they're coming from, most of the jobs that we've added have been government jobs, not private sector. Services are down, right? Manufacturing's low. It's like most of it's government jobs, and that doesn't look good either. It's like it's kind of a fluffy, a bit of a fluff for the non-farm payrolls, which we also have on Friday. A couple things I just pulled out here. So we were mentioned, is it under Democrat or Republican? It really doesn't matter. If you look at these key points, S&P achieved an annual compound growth of 9.8% under Democratic presidents and 6% under Republican presidents since the modern S&P in 1957. So we've got roughly about 70 years of that. S&P has achieved a median compound annual growth of 8.9 under Democratic president, 10.2 under Republican since 1957. return, almost 2,000% over 30 years, which is compounding at 10.5% annually. It doesn't matter, dude. We've had Republicans and Democrats over that 30-year period. Market doesn't really care. You look at the compound annual growth rate, Democrat versus Republican. And this doesn't bring into account of who's in Congress, right? What's the House? What's the Senate? Is it split? Is it divided? Is it gridlock? I don't really think it matters, dude. I think if we have companies with room to run and there's valuations that continue to be justified, look, when we see crashes in the market, we just see an asset bubble. That's what the Fed is. That's what the Fed has created more often than not. Is they backstop. They have this kind of soft landing, or they fight off crisis, but then they create a freaking asset bubble, and then valuations get so frothy that they're not sustainable. Revenue growth can't meet the numbers that's out there for the consensus. And that's where we see crashes and corrections. Now, you pair that with all the crap underneath that's actually bubbling under the surface that should be a problem. And then all of a sudden it just like dominoes into like this horrible situation. So that's where the crisis has been. Like 2000, 2001, 2008, 2020, that's what it was. We just had the Fed, step in and backstop things a lot faster in 2020. Yeah. So I don't know. My point is, I don't think it's really going to matter. If we have problems under the surface and companies are reaching valuations that they can't justify, here's going to be my especially for tech. I mean, tech is certainly, your space, and you like tech, and that's been a great trade for you. If we start to see tech as a whole not meeting expectations, if we're seeing growth trends plateau or growth trends going down, that's not a good time to be long, right? So I mean, there's going to be evidence in the numbers, and there's going to be evidence in the data that we need to watch. But until then, look, if Nvidia keeps popping up and Microsoft beat this week, and if Apple and Amazon beat this week, and we've got Meta today, if it beats today, it's like, look, Mag 7's the Mag 7, and it's there for a reason. If it keeps saving this market, so be it.
And that's the thing, Chris, is the concept of tech, the concept of my positioning in it, it is really truly a trade, because to your point, I do also recognize that on a long-term basis, tech is probably overvalued. Price to earnings wise is probably expensive, but that's why we've got stops on the trade, as you're pointing out. In the meantime, if the party's going to roll on, the place to be at is probably tech, unless we get rate cuts probably mean that there's other participation. But to me, it's kind of like, in either scenario, if the market's going to go up, tech's probably going to do well. Doesn't necessarily mean tech has to lead. But I do think that it will participate at the very least if we see an up move. The question then becomes, as we watch these earnings, I've been very vocal about, if we get something out of Meta, if we get something out of Apple and Amazon, if we see serious threats to the AI idea, I think that's the biggest threat to the trade is beyond just, what the Fed does. Even as you pointed out earlier, good companies, good earnings, that's going to trump the entire thing. That's the question for me with the NASDAQ trade and the semiconductors trade is, can we support these multiples with good earnings and good forward guidance? If we can, then the party rages on. But if we can't, I got to get out of there.
For sure. And, I think you're silly to think that, tech is a space that's overcrowded, or it's too much FOMO. It's like, look, the US has essentially become a tech index. I mean, if you look at the S&P 500, it's been carried by 10 tech stocks. If you look at the NASDAQ 100, it's all tech stocks, and it's still been carried by the top 10 tech stocks. So even if you're in the Russell 2000, you still have exposure to tech. So, I mean, the reason we've had such a good run and we've annualized, 9, 10, 12, 15, 16%, it's because of tech. And the reason why is also tech doesn't have the hard goods costs associated with it. If you want to make more oil and buy $1 billion rig, that's a hard expense that you can't just make up for. That's going to take years to get online and years to pay for itself. That's a much different cost associated versus, hey, we're just going to pivot to this thing called AI, and we're going to make all of our analysts use, Chat GPT, and we're going to do generative AI and run all these programs and, spend as much money as we can in this space. Well, I think that's where the issue is like, do we have an AI? Is it actually worth what the investment says it's going to be worth, or is it hyped? And so maybe that's the breaking point of AI is like, is it actually worth the investments that, I mean, we talked about this earlier. I don't know if it was, this week or last week, but I mean, Zuckerberg was raked over the coals when he was going into the metaverse and going all in with Meta and Facebook on spending. And if Google is saying, look, you can't afford not to spend, and if Microsoft says you can't afford not to spend, and all of a sudden it's like you're putting a bigger percentage towards AI, that is the return on investment going to benefit investors? Because if it does, great, it's all justified. But if
And that's
it's
the thing
not,
is,
you don't know.
yeah,
This is what we don't know.
no, you're exactly right. That is the biggest concern for the AI trade. And that's why I think, the biggest piece to pull out of the earnings, and why admittedly Microsoft very much surprised me, the market's reaction to Microsoft, because their cloud earnings were
Yep.
a little bit lower, and they're one of the few companies that the market points to and says, hey, look, AI is working. So when you have these big earnings occurring, the market is starting to demand, and maybe next time around will demand even more so, that these AI investments do come to roost. The one thing that I keep thinking about though too is that if we say, okay, the AI trade requires we want to see some return on investment. Well, the market may also afford it a little bit more time and leniency if rate cuts do occur, because suddenly the borrowing costs for a lot of these companies may slightly come down. Maybe the idea is that, with that reduced borrowing costs, a lot of other companies can start investing in AI too. And so is it one big Ponzi scheme that has no returns on the other side? I don't know. But my view on it, there's a lot of picks and shovels companies that I like to lean into, like the semiconductors, but also, as I've said over and over, the cybersecurity stuff. The defense for counter AI will also be a forced spending. There's no, if AI gets really good at what it does, at faking things, at faking leadership, or like leadership saying something, or your cousin calls you asking for money, the demand is the spending to defend against AI will be massive, just like the spending for AI is too. So I kind of see it as like there is just going to be perpetual spending on many fronts for this. There's spending on the government level. Governments have to have counter AI and chips to do all their stuff. And then you have individuals who may need to purchase software, or at least use tools that defend them from AI stuff. And then there's businesses who need to protect their assets and also protect their customers using AI. To me, I just see the companies like CrowdStrike, Palo Alto, Fortinet. I love those companies for that reason. But those valuations are crazy if you see the AI story dry up. So you have to be careful with this stuff. This is why it's high risk, high reward to play tech at all.
Yeah, and look, I think it's pretty apparent that the Bitcoin / blockchain trade is still stable. I don't think that AI is just over and done with. I think it's big enough that
Yeah.
companies see that if they can actually embrace AI and become more productive and become more profitable, enhance their margins. AI is and look, it can all be under the bow tie of AI. You can call it AI, but it
Mm.
just means you have less people doing more work and you're just as
Yeah.
productive, you're higher margins, and like all these things are good for companies' bottom lines and profitability. So from that standpoint, I mean, AI as the blanket trade of more profitability, doing more with less, it's all good in my opinion. I just wonder if it's like when companies are over investing and not really getting the ROI, if that's
Yeah.
ultimately where this thing
Well, think
cracks.
about like the call for 6 rate cuts at the beginning of the year. Like the market
Yeah,
can get, even about something that it's right about, it can get ahead of its skis, right? So
for
I
sure.
totally understand with the tech stuff. There are some technical levels that I'm watching very closely on, like on the cues. I mean, if
Yep.
we break that previous low, I got to get out of there. I got to say something has not worked right on this idea,
Yep.
because this is not my first attempt either. I have taken a couple attempts at the NASDAQ. I bought once here, bought once here, and this is my third attempt to get long the NASDAQ. On my third attempt, if we just break through the lows, I got to seriously consider if I want to try again. And
Sure.
if so, I need to have a good reasoning for it, maybe a catalyst, maybe, something further, because, if this is going to become a 10% correction at some point on the stock market, I'm a trader. I want to be flexible enough to recognize that might be coming and get out
Yep.
of the way. So right now, we've got a good candle on the upside for the stock market. But again, we are just 15 minutes or so away from the press conference, which could either continue this move or completely reverse it, or just volatility is expected.
Yeah.
Chris, do you have anything? You mentioned you closed out some of your Qs trades.
Yep.
Uh, Would you say that going into this meeting, do you have any positions on the stock market as an overall, maybe S&P or Qs?
Yep.
Where are you leaning? I think you mentioned slightly bullish, right?
Yeah, so where I'm leaning slightly is I need to see, and this is just for short-term profits for this week. I need the Qs to stay above 460 this week, and they're
Okay.
right now printing what are the Qs at right now? 469. So I've got about almost a $10 head start for my line in the sand. So as long as we stay above 460, that's credit. As long as the IWM stays above 218, that's credit. I've got a broken wing on the NWX or the NDX, so the Nasdaq Futures Index. That's probably 99.9% profit right now. I just have to, let it expire on Friday. So I'm leaning bullish as far as I think that the 10% level. The reason I played the Qs this week instead of the S&P is I thought, look, 10% is a pretty good correction. Now I know it's more volatile than the S&P, but I thought maybe the S&P pulls back a little bit. This was mostly a tech-led earnings week, right? You've got Microsoft, you've got Apple, you've got Amazon, which I know are in the S&P. But as far as moving the needle, just like we had back in April and May, those stocks I just mentioned are pretty much what saved the market in late April and May. Once we started to see that rally in May, that was because of Apple earnings. And Apple didn't really have a great earnings report. They just said, we're doing buybacks.
Yeah.
We're going to kick the can down the road, and we're investing. We're looking at the AI space, and they have this big update. And Apple has been one of the best comeback stories of the year. Tesla, same type of thing. Tesla's interesting because it's still really sensitive. They keep missing the marks on some revenue or some earnings. But what Tesla's doing, and I don't think anybody really appreciates right now, is they are just cutting costs like crazy on their cars, and they're doing it better than everybody else. Like Ford was up to $14, now it's back down to 11. GM has fallen flat. I mean, your EV sales, I don't think Ford can make a $30,000 electric car. I don't think that GM can make a $30,000 electric car or make one that people want to buy. So to Tesla's credit, they still are making cars, even if they're $30,000 to $40,000. They're making cars that people want. I mean, I see them everywhere, and I mean, I'm looking at the homes and places to rent or to buy. A lot of them are putting those Tesla chargers right in the garage. And you can have like the medium speed charger, so they sit overnight and you get a full charge by the next morning. So I mean, it's there. It's like, and this isn't like a bullish case for Tesla necessarily, but I think even as much as Tesla gets crapped all over because like, oh, Elon Musk is crazy and it's not, the value isn't there, they're missing on earn. I still think Tesla's not an automaker. Tesla is much more, as far as the bigger picture. Tesla is it's a skeleton for tech and energy and disruption and things that hopefully in the long run are going to be something that makes the company very profitable. So I think that right now it's like I lean towards the Qs because a 10% correction was enough to take a stab and take it, dip my toe in the water is what I did. So Qs and IWM, what I'd like to see is, I mean, one of my favorite trades for the rest of this year, and I hope it's right, would be the IWM playing catch up. And there's two things I want to talk about. This actually goes back to what I said early in the
Yeah,
show
I was going to
today.
ask you about small caps.
Yeah,
Give
so
us your, I mean, this chart looks pretty good on IWM.
I
You take a
agree.
look at the Russell. I mean, it looks like I was mentioning, I think right before you stepped on, looks like a really clean bull flag on the daily chart. Zoomed in a little bit here. I mean, look at that. I mean, just
Yeah.
tagged support. Edgefinder's got a nice bullish reading on it too. So I'm either looking for a break and retest or a pullback into this level here. So I don't know. What are your thoughts on small caps?
I think if we can stabilize the S&P and the Nasdaq, we can start to see a broader market lift and have the Russell actually play along with it. So rather than seeing the separation of S&P is up and the Nasdaq is up and the Russell's flat and the Dow is flat, we might see that we have all four indexes pushing higher going in
Mhm.
towards the end of the year. Doesn't matter what the election's going to give us. Doesn't matter if the Fed's going to cut rates, even though it does matter because I think this is why the Russell jumped the way that it did. But the reason I like this trade is if there's a catch-up trade, and this is what I talked about earlier this morning with silver, I can see a target on the small caps. If we get to all-time highs on the small caps, that gives me another 10 to 11% to the upside based on current prices. So taking this right now, getting to all-time highs in the IWM, we're talking about a move of about 9%.
Yep.
9% in an index is pretty darn good. And I know that might be a catch-up trade where maybe the 9% is, 9% for the Russell, but it's 3 to 4% for the SPY, or it's 3, 4, 5% for the Qs, but it's still an outperformance. I'll take that outperformance because that's alpha. It's
Yeah.
probably going to outperform the Dow. So I like the small caps in that regard, but I don't think the small caps will move all by themselves. I don't think the Russell's going to go break all-time highs with the S&P and the Qs dropping. I think in order to break all-time highs in the Russell, we have to see everything be stable or up. and then the small caps can go with it. We can have like a broad market participation as opposed to 2 indexes up, 2 indexes flat, and now we're wondering which is which, you know?
Yeah. No, I mean, I think if you're looking at the Russell, you got to ask yourself, do you see where does the growth typically do? Where does the Russell typically do the best? And what you kind of find is, historically speaking, usually the Russell does very well when you get the Goldilocks zone, where you
Yep.
have inflation not threatening, but not okay. So here's where you want the Russell. This is my take on it. Inflation, you want it between 2 and 3. You don't want it lower. You don't want it higher, because lower would it signal the economy's slow, and higher would involve problems like we've seen with rate hikes, which crush the Russell. Then you want, on top of that, you want growth to be as strong as possible, right? The more growth, the better. But 2 to 3% inflation is seemingly attainable, and growth doesn't seem to be cracking. And we've got the final one, which is interest rates are going to become less threatening pretty soon.
Yep.
If I mean, we might be seeing the right setup for the Russell to make a big move. I don't know if I'm a Tom Lee about it, right? Tom Lee's out here saying,
15,000 is
100%.
high. S&P, yeah.
Frank and I
Bitcoin to a
always,
trillion. Did you see that one? That was a good one.
no way. Did he
Yeah.
really say that?
Bitcoin to over a trillion.
And he does this face. Frank and I always make fun of his. He does this little smirk on his face whenever he says these crazy predictions. Yeah, it'd be like SPY to or SPX to 15,000, and just give a little smile and a nod, and it's just like, dude. But anyways, yeah, I mean, I do think that he might be a little aggressive in how bullish he is on small caps, but I don't think he's wrong about being bullish on small caps, and he's
Sure.
been very right about this bull market. I mean, of course, they can always drag out the biggest bull in the room and make him look like a hero when it's going up. But
Right.
I don't know. I think I like the setup for small caps as well. Especially, I mean, this is one thing, not to get overly political, but if the tariffs do come into the picture from Donald Trump, I do think that kind of favors domestic small cap companies. So if you do get a Trump election, it might lean a little bit more favorable towards small caps, because think about the small cap index. It's a lot of domestic businesses. It's a lot of U.S. focused companies, which could theoretically do better in a increased tariff environment. So maybe that's one area where the specifics, and that's one thing, if you're talking about the broad stock market's performance under a Democrat or Republican, probably not going to give much of a difference. But specific policies like clean energy policies or tariffs or things like that can certainly impact specific industries or parts of the market. So I think that is worth at
Absolutely.
least thinking about.
I listened to it was a segment on Tasty Live yesterday, and I think it was Chris Vecchio made a really good point. He said that for the most part, for us that do this for a living and do this for day to day and week to week and year to year, for us to get things right, all we really have to do is get sentiment in the sector. If we can
Yeah.
get those right, that covers about 80% of the market
I mean,
direction.
if you got the right sector this past 2 years, you look like a hero. But
That's
if you got it
exactly my point.
wrong, I
Yep.
mean, it was most sectors down, a couple up, or not
Yep.
down, but the outperformance was very, very narrow, as we know.
Correct. And that's the point is like, so, this has been, for the most part, sectors have been returning to green, but for
Mhm.
the traders that have been, since 2020, I know a lot of smart traders and a lot of smart funds that are talking about, value, value, value. Everything's got to be like just dirt cheap. And look, give it maybe 2, 3, 5 years, maybe those all start to play out really nicely as well. But those sitting in value and those sitting and waiting and missing out on 100+% upside and 30% gains and 50% gains. And I mean, look, I'm talking about this is a lucky pick for me this year, because I did not intend to get into this stock with the idea of jumping
Oh,
price
you played MO?
25%.
Congrats on that. Great dividend and a nice rebound play.
Yeah, so I bought this when I got some clients signed on board. The first thing I did for a dividend play was I started to get some MO around $39, and we had over $10 of gains in just the stock itself, and some nice gains in the actual it's like $1,000 dividend every quarter. So if I
Wow.
show here, I'll go to my portfolio here. Let me go to MO. MO. So this is one individual account that's up around $6,600. If I go to the whole portfolio, it's up a decent chunk, man. I mean, the whole portfolio has got about 65 grand in MO. I've got it covered at 50. I don't really want to lose the stock if I don't have to. But if I do get it called away, it's like everyone's going to make around $8,000 or $9,000 with an extra $1,000 kicker per quarter on top of that with dividends. And so like longer term, it's like this is a stock that I can continue to play and just kind of hold the cost basis around $40. I mean, my cost basis is not that far off of like COVID lows. So I don't really want to get the stock called away. If we're going to get, 94 to 98 cents a quarter, I'm all about it, man. So I just think this is an interesting play where it's like, this has nothing to do with like the tech sector. But we've seen some interesting jumps, like because of interest rates looking to get cut, house builders jumped again, like Pulte and Lennar, DR Horton, they all jumped up again. Yep. Regional banks, if you go to is it KRE? Yeah, KRE, which was, arguably one of the worst things you could ever trade simply because of the regional bank crisis. But look, you're talking about a $35 to $58 jump. That all by itself has been a nice part of this rotation. This is up 67% from the crisis we had with Silicon Bank and First Republic back in 2023. So sectors have been a little bit all over the place, but it's mostly been led by narrow tech, consumer, communication services, tech sector, and semiconductors, right? And so for those value plays, it's like value's done next to nothing, although everyone's resting on value outperformed by blah, blah, blah percent. It's like, yeah, but it might have been still in a drawdown. And the whole market's down 50%. I don't care about value. It's like nothing is good when the market's down.
And that's the thing, Chris, is it's been, in 2023, I was super, super tech focused. I was like, that was like everything for me. So that's why 2023 was a monster year for me. Yep. 2024, I messed up. I got out of the tech stuff and I didn't mess up. I just didn't make nearly as much as I could have, shoulda, coulda, woulda, hindsight 2020. I got more into gold and I got more into kind of well-rounded stuff, which has not performed as well. But I'm back on the tech trade and I'm going to stick with it until it breaks. It could break at any moment. And, maybe we see it in quite literally in a few moments, but we'll see. Chris, we got it is a show. We got Jerome Powell coming up and doing his show in just a few minutes. I'm going to let you go this time for real. Thank you for coming on. I don't want to have to make you sit through and listen to him, the old man speak. You can listen to the show, and if anything gets really interesting, we'll bring you back. But thanks.
I'll be in the background. If you guys need me, I'll be here.
Okay. Yeah, I'm probably just going to listen. So before we let you go, let me just mention, everybody, guys, go support Chris Pulver on his YouTube channel. Make sure to go subscribe. Go find him on Twitter at real Chris Pulver.
That's it. Yeah.
Yep. Real Chris Pulver. Yep. I blanked for a second. I say it every day, but it starts to. It's like when you say or read a word. James and I were talking about this. When you like type a word out and you're like, that didn't seem right. Anyways, Chris, we got to go. We got him showing up. So thanks for coming on.
All right. Thanks, Nick.
See ya. All right, we can switch over. I think we got I can't tell if he's on the stand or not from my view. I don't think he is. Oh, here he comes. The man, the myth, the legend.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance, and the unemployment rate remains low. Inflation has eased substantially from a peak of 7% to 2.5%. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. We are attentive to risks on both sides of our dual mandate, and I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP growth moderated to 2.1% in the first half of the year, down from 3.1% last year. Private domestic final purchases, or PDFP, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal of underlying demand, grew at a 2.6% pace over that same period, the first half. Growth of consumer spending has slowed from last year's robust pace, but remains solid. Investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment stalled in the second quarter after a strong rise in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 177,000 jobs per month in the second quarter, a solid pace, but below that seen in the first quarter. The unemployment rate has moved up, but remains low at 4.1%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market have returned to about where they stood on the eve of the pandemic, strong but not overheated. Inflation has eased notably over the past 2 years, but remains somewhat above our longer run goal of 2%. Total PCE prices rose 2.5% over the 12 months ending in June. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As the labor market has cooled and inflation has declined, the risks to achieving our employment and inflation goals continue to move into better balance. Indeed, we're attentive to the risks to both sides of our dual mandate. We have stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. The second quarter's inflation readings have added to our confidence, and more good data would further strengthen that confidence. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the longer run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Gina Smilik from the New York Times. Thanks for taking our questions. Markets pretty much entirely expect a rate cut in September at this stage. I wonder if you think that's a reasonable expectation, and if so, why not just make the move today?
Thank you. So on September, let me say this. We have made no decisions about future meetings, and that includes the September meeting. The broad sense of the committee is that the economy is moving closer to the point at which it will be appropriate to reduce our policy rate.
Interesting.
In that we will be data dependent, but not data point dependent.
That's about as close as a
confirmation
confirmation
as
you
you
get.
Responding specifically to one or two data releases. The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September.
Wow.
So you asked why not today? And I would just say, again, that the broad sense of the committee is that
there it is.
Closer to the point at which it will be appropriate to reduce our policy rate, but that we're not quite at that point yet.
Howard.
Now ask him about November.
So just to follow up on that a bit, if inflation behaves as you expect between now and September, would you regard a cut in September as sort of the baseline scenario right now?
So I guess I would think about it this way. I'll give an example of cases in which it would be appropriate to cut and maybe that it wouldn't be appropriate to cut. So if we were to see, for example, inflation moving down quickly or more or less in line with expectations, growth remains, let's say, reasonably strong, and the labor market remains, consistent with its current condition, then I would think that a rate cut could be on the table at the September meeting. If inflation were to prove, stickier and we were to see higher readings from inflation, disappointing readings, we would weigh that along with the other things. I think it's going to be not just any one thing. It's going to be the inflation data. It's going to be the employment data. It's going to be the balance of risks as we see it. It's going to be the totality of all of that help us make this decision.
And just to follow up on that, specifically, in what ways right now, given all you've seen over the last few months in particular on shelter, on services, et cetera, in what ways are you not confident right now that inflation is on the way back to 2%?
I think it's just a question of seeing more good data. We have seen the last couple of readings have certainly added to confidence, and we've seen progress across all three categories of core PCE inflation. That's goods, non-housing services, and housing services. So it's really just, we had a quarter of poor inflation data at the beginning of the year. Then we saw some more good inflation data. We had 7 months at the end of last year. We just want to see more and gain confidence. And as I said, we did gain confidence, and more good data would cause us to gain more confidence.
Colby.
Thank you. Colby Smith with the Financial Times. The March SEP pointed to 3 cuts in 2024 with core inflation at 2.6% and the unemployment rate at 4%. Since we're now at that level in terms of inflation and already beyond what was projected for the labor market, I'm just wondering if that rate path is back to being the best guidepost for policy rather than, let's say, the shallower one laid out in the June SEP.
So I would just say, really the path ahead is going to depend on the way the economy evolves. And I can't really give you any better forward guidance on it than that. We didn't, of course, do an SEP at this meeting. We will do another one at the September meeting. I would just say I can imagine a scenario in which there would be everywhere from 0 cuts to several cuts, depending on the way the economy evolves. And I wouldn't want to lay out a baseline path for you there today. I've said what I can say about September and about today, though.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've said before that you wouldn't wait until inflation got to 2% to cut rates because of how inflation has lagged. Does that apply for the labor market too? If the labor market is back in equilibrium, why is restrictive policy and potentially very restrictive policy, given the high real funds rate, warranted right now?
So this is the very reason that we're thinking about we've said in our statement that we're going back to looking at both mandates and that we think the risks are coming back into balance. We think what the data broadly show in the labor market is an ongoing gradual normalization of labor market conditions. And that's what we want to see. We've seen that over a period of a couple of years, and a move really from overheated conditions to more normal conditions. We are watching the labor market conditions quite closely, and that's what we're seeing. If we start to see something that looks to be more than that, then we're well positioned to respond. That's part of what we're thinking.
And when you talk about seeing something that's more than whatever softness or slowdown you expect, in the past, you've said that stronger growth wouldn't override better news on inflation. I wonder how that cuts the other way. If you're seeing more softness in the labor market than what you would expect, does that change the calculus on what you're looking for out of the inflation numbers to recalibrate policy?
So we have growth isn't one of our three. We have two mandates, as you know. The labor market, maximum employment is one, and stable prices is another. So we weigh those two things equally under the law. When we were far away from our inflation mandate, we had to focus on that. Now we're back to a closer to even focus. So we'll be looking at labor market conditions and asking whether we're getting what we're seeing. And as I said, we're prepared to respond if we see it that it's not what we wanted to see, which was a gradual normalization of conditions. If we see more than that, and it wouldn't be any one statistic, although of course the unemployment rate is generally thought to be a good single statistic, but we'd be looking at wages, we'd be looking at participation, we'd be looking at all the things, surveys, quits, hires, all of those things to determine the overall status of the labor market. But we're looking at it now. I would say, again, I think you're back to conditions that are close to 2019 conditions, and that was not an inflationary economy. Broadly similar labor markets then. I think core inflation was actually running below 2%. So I don't now think of the labor market in its current state as a likely source of significant inflationary pressures. So I would not like to see material further cooling in the labor market, and that's part of what's behind our thinking. The other part, of course, is that we have made real progress on inflation, and we've got growing confidence there that we are not quite there yet, but we're getting more confident that we're on a sustainable path down to 2%. So those two things are working together, and we're factoring those both into our policy.
Chris.
Chris Rugaber at Associated Press. You mentioned not wanting to see any further cooling in the job market. Why not, or would you consider preemptive cuts to prevent if you saw risks of an unexpected cooling? Is that something you would cut ahead of time for?
So I wouldn't say I wouldn't want to see any other cooling. It would be more of a material difference. If we'd be looking at this and if we see something that looks like a more significant downturn, that would be something that we would have the intention of responding to. So in terms of I don't think of it that way. I think of it as, we're actually in a good place here. We're balancing these two risks of, go too soon and you undermine progress on inflation, wait too long or don't go fast enough, and you put at risk the recovery. And so we have to balance those two things. That's the nature of having two mandates. And I think this is how we balance them. It's a rough balance, but it does feel like the labor market feels like it's in a place where it's just a process of ongoing normalization. 4.1% unemployment is still historically low. And we'll just have to see what the data show us.
And just to follow quickly, wanted to see what you thought of the recent JOLTS report, which did show gross hiring has come down even below 2019 levels. Layoffs remain low. So it painted a picture of a very static labor market. Is that sustainable in your view or something that is worrying? Thank you.
So I think all of the data points continue to point to kind of the direction we would want to see. So that was taken as there was a decline in job openings. That was good. Today's ECI reading was a little softer than expected. So that's a good reading. It shows that wage increases are still at a strong level, but that level continues to come down to more sustainable levels over time. That's exactly the pattern that we want to be seeing. So I think the data we've been seeing in the labor market are broadly consistent with that normalization process. Again, we're closely monitoring to see whether it starts to show signs that it's more than that.
Steve.
Steve Leisman, CNBC. Mr. Chairman, back in March, you talked about cutting rates as a process, and in June, you talked about the idea that, well, one rate cut wouldn't do anything. So I wonder if you can sort of follow up on Colby's question. Talk about, are you weighing the economy right now in terms of its ability to withstand multiple rate cuts? Talk us through the process that you're thinking, or is it just one rate cut? Or are you in the process now thinking that rates need to be normalized here? Thank you.
Yeah, I can't really say that, honestly. We've seen, significant movement in the labor market. And, we're very mindful of this question of is it just normalization or is it more? We think it's just more normalization, but we want to be in a position to support the labor market. At the same time, we're seeing progress on inflation. So, we actually got to this, we raised rates a year ago at the July meeting. And if you look at the situation in the economy a year ago, inflation was over 4%. It was a completely different economy. Now we've made a lot of progress, and the labor market, as I think, unemployment was in the mid threes. So it's a different economy, and I think it's coming to be time to adjust that so that we support this continued process. The thing we're trying to do is, that we've had this really significant decline in inflation, and unemployment has remained low. And this is a really unusual and historically unusual and such a welcome outcome for the people we serve. What we're thinking about all the time is, how do we keep this going? And this is part of that. We think we don't need to be 100% focused on inflation because of the progress we've made. 12-month headline at 2.5, core at 2.6. It's way down from where it was. The job is not done on inflation, but nonetheless, we can afford to begin to dial back the restriction in our policy rate. And I think we're just as part of a process. In terms of what that looks like, I think most you would think in a base case that policy rates would move down from here, but I don't want to try to give specific, forward guidance about when that might be, because the pace at which it might happen, because I think that's really going to depend on the economy, and that's highly uncertain.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. On inflation, do the past few months of good reports look like what we saw last year, where you really had a lot of momentum with a few bumps in between? Would you characterize that kind of momentum as back on track at this point in the year?
Actually, what we're seeing now is a little better than what we saw last year. Last year, as we pointed out late in the year, a whole lot of the progress we saw last year was from goods prices, which were going down at an unsustainable rate, disinflating at an unsustainable rate. This is a broader disinflation. This has goods prices coming down, but we're also now seeing progress in the other two big categories, non-housing services and housing services. So, so the thing is, you got 1 quarter of that. We had 7 months of low inflation. You got 1 quarter of this. I would say the quality of this is higher, and it's good, but so far it's only a quarter. So I think we need to see more to know that we're, to have more confidence that we're on a good path down to 2%. But as I mentioned, our confidence is growing because we've been getting good data. And things like the ECI report and frankly, the softening in the labor market conditions, give you more confidence that the economy's not overheating. It doesn't look like an overheating economy. And it looks like an economy that's normalizing.
Okay. And if we were to think about the first couple of months of the year, is there any sense now that they were these blips that could have actually allowed for earlier rate cuts, as were some of the projections going into 2024?
So the thing about if what it is seasonality, and it could just be, it's very, very hard to do appropriate seasonal adjustments. If that's what it is, then that actually implies that other months were reporting too low inflation. If you smoothed it out, it's a zero-sum game. And that's why we look at 12 months. We look at 12 months because that takes all that out, all those effects out. 12-month now is 2.5% headline, 2.6% core. This is so much better than where we were even a year ago. It's a lot better. Now, the job is not done. I want to stress that, and we're committed to getting inflation sustainably down to 2%. But we need to
pull it
take
back
note of
there.
that progress, and we need
He's
to
getting too
weigh
dovish.
the risks to the labor market and the risks to our inflation target now more equally than we did a year ago.
Michael McKee.
Michael McKee from Bloomberg Radio and Television. I'd like to ask you about the balance of risks as the American people see it. At this point, is the risk greater to leave interest rates where they are, given the damage that higher interest rates do to the economy in slowing demand and raising prices? Or is it more important for the American people that you keep rates where they are to bring inflation down?
I think that we've been given an assignment by Congress. This is how we serve the American people, is by achieving maximum employment and price stability, right? And so in our, quasi-constitutional document, the Statement on Longer Run Goals and Monetary Policy Strategy, we look at the two goals, and if one of them is farther away than the other, the two variables, inflation and employment, if one is farther away from its goal than the other, then you concentrate on the one that's farther away, and you take account of the time to reach the goal. So for the last couple of years, the best service we could do to the American people was to focus on inflation. But as inflation has come down, and I think the upside risks to inflation have decreased as the labor market has cooled off, and labor market has softened, probably the inflation is probably a little farther from its target than is the employment. But I think the downside risks to the employment mandate are real now. So we have to weigh all that. And if you think about where that takes us, is we have a restrictive policy rate. It's clearly restrictive. It's been the rate we've had in place for a full year. And the time is coming, as other central banks around the world are facing the same question. The time is coming at which it will begin to be appropriate to dial back that level of restrictions so that we may address both mandates.
Well, you have event risk basically with the jobs report on Friday and another one before you meet again. Are you certain that you won't fall behind the curve and lead to unnecessary unemployment if you wait until September?
Certainty is not a word that we have in our business. So we get a lot of data between now and September, and it isn't going to be one data read or even two. It's going to be the totality of the data, all of the data, and not just it. And then how is that affecting the outlook, and how is it affecting the balance of risks? That's going to be the assessment that we do. Of course, we'll all look carefully at the employment report, but so much other data coming in, and so much happening between now and the September meeting, and we'll make a judgment.
Edward.
Thank you, Mr. Chairman. Edward Lawrence of Fox Business. I do want to dig deeper on what Michael and what Nick were asking. There's a shift in the statement to balance between the focus between inflation and jobs. Looking at the job sides, we've seen wage data show sort of an abrupt slowing. We're hearing on earnings calls from companies like Intel abrupt layoffs. In the jobs report from the BLS, government jobs has been a leading creator. Could the government jobs as a sector hiring mask underlying weakness in the jobs report?
Well, we'll look at everything. We've seen some tendency to have a narrowing base of job creation in some months going back, but then we've had some months where job creation was broader, and also the headline number of jobs has come down. So but you look at the whole thing, and I think you do look at private demand extra carefully. To your point about government. So we'll just be looking at all those things.
So as a follow then, so could the Fed then be behind the curve? Because you said some of the reports last meeting, you said the reports could be noisy or overstated. Was there a discussion of what kind of discussion was there for a cut today? And could the Fed be behind the curve?
Yeah, so look, the objective is to balance the two risks, right? It's the risk of going too soon and the risk of going too late. We've been, we had 7 months of good inflation data at the end of last year. We said we wanted to see more. We pointed out that too much of this was coming from goods, and sure enough, the first quarter wasn't great inflation data. Now we've got a quarter that is good, and we're balancing the risk of going too soon against the risk of going too late. That's what we're doing. There's no guarantee in this. It's a very difficult judgment call, but this is how we're making it. But in terms of today, your question about today, we did have we had a nice conversation about this issue today. The overall sense of the committee, as I mentioned, is that we're getting closer to the point at which it'll be appropriate to begin to dial back restriction, but we're not quite at that point yet. We want to see more good data. The decision was unanimous. All 19 participants supported it. But there was a real discussion back and forth of what the case would be for moving at this meeting. A strong majority supported not moving at this meeting. That was the strong sense of the committee, but it's a conversation that we had today, certainly.
Courtney.
Courtney Brown from Axios. Thank you for taking our questions. When the Fed was raising rates, there was a lot of conversation about long and variable lags. I wonder if that applies on the way down too. How are you and the committee thinking about that?
Yes, it does. And I think the lags have kind of showed up here in the last 6 months, by the way. You really do now see the restriction. Whereas, even a few months ago, people were questioning how restrictive policy was. Look at the labor market now. You can see, and look at inflation, rate-sensitive, interest-sensitive spending. You really do see now that policy is restrictive. I wouldn't say it's extremely restrictive, but it's certainly effectively restrictive. Yes, the lag should be on the way down. It should take some time to get into the full economy, affect financial conditions, and that affects economic activity, hiring, and that kind of thing, and ultimately inflation. It's not instantaneous, although it's faster than it used to be because markets move now in anticipation of our moves.
So are you worried then that if monetary policy acts with long and variable lags, even when you're lowering interest rates, it might be too late for the Fed to help stave off any kind of slowdown in the labor market or broader economy?
Yeah, we have to worry about that. You're just to make it clear, it's a very difficult, challenging judgment, and we don't want to go too soon. We don't want to go too late. But this is how we've made that judgment. I feel good about where we are. We're certainly very well positioned to respond to weakness with the policy rate at 5.3%. We certainly have a lot of room to respond if we were to see weakness. That's not what we're seeing, though. What we're seeing, look at the first half growth numbers. Look at PDFP at 2.6% for the first half. It's not signaling a weak economy. It's also not signaling an overheating economy. Labor market, admittedly, the unemployment rate has moved up 0.7, and we're seeing a normalization there. But wage increases are still at a high level. Unemployment is still at a low level. Layoffs are very low. Initial claims have moved up, but they're pretty stable, and they're historically not high at all. So the total scope of the data suggests a normalizing labor market. And again, we are carefully watching to see that continues to be the case.
Victoria.
Hi, Victoria Guido with Politico. On the labor market, I was wondering, how worried are you all about unemployment rising to the point where it triggers the SOM rule? And would that potentially affect how quickly you cut rates?
So I would just say that the question really is one of, are we worried about a sharper downturn in the labor market? So, and the answer is we're watching really carefully for that. We're aware of that rule, which is really I would call it a statistical thing that has happened through history. A statistical regularity is what I'd call it. It's not like an economic rule where it's telling you something must happen. So again, what do we see? What are our eyes telling us? We look at all the things we're seeing, and what it looks like is a normalizing labor market. Again, job creation at a pretty decent level, wages moving up at a strong level, but coming down gradually. Job vacancies have come down, but they're still high by historical standards. So again, I've been through some of the data already, but what we think we're seeing is a normalizing labor market. And we're watching carefully to see if it turns out to be more, it starts to show signs that it's more than that, then we're well positioned to respond.
Is there reason to think that the labor market might behave differently this time than it has historically?
I think, history doesn't repeat itself. It rhymes. I think that statement is very true about the economy. You never assume it's going to be just the same. An example would be, is there a trend increase in the level of vacancies? There are many, many examples. So it's never exactly the same. Also, let's remember that this pandemic era has been one in which so many, apparent rules have been flouted, like the inverted yield curve, for starters. So many pieces of received wisdom just haven't worked. And it's because the situation really is unusual or unique in that so much of this inflation came from the shutdown of the economy and the resulting supply problems in the face of admittedly very strong demand. So the whole situation is not the same as many of the other prior inflation or downturns that we've seen, or business cycles that we've seen. So we're having to learn, we're having to, to be very careful about the judgments that we make, I would say. So we don't assume that these regularities will just repeat themselves automatically.
Amir.
Thank you, Chair Powell. I'm Mara Mokwe with Bloomberg. There seems to be quite a difference between what the anecdotal data are telling us, such as the very recent downbeat beige book, and the hard data. Do you take those anecdotes seriously? That is, that the economy and labor market are cooling much more rapidly than what's shown in the data?
So I do take that seriously, and the beige book is great. What's even greater is hearing the Reserve Bank presidents come in and talk about their conversations with businesses and business leaders and workers and people in the nonprofit sector in their districts. But I'll tell you, it's a pretty, the picture is not one of a slowing or, a really bad economy. It's one of, there are spots of weakness and there are regions where growth is stronger than other regions. But overall, it's, again, look at the aggregate data. Aggregate data is, particularly PDFP, private domestic final purchases, is 2.6%, and that's a good indicator of private demand. So we listen to all of that, and it does. I think it's important to listen to anecdotal data and not just look at the aggregate data. Especially, it's very hard. GDP data can be volatile quarter to quarter, so it's just hard to measure economic activity. There are a lot of. It's just difficult to do. So I look at both. Yeah, but I wouldn't say that the anecdotal data is uniformly downbeat. It's more mixed.
Thank you. Jolene Kent with CBS News. Chair Powell, thanks for taking our questions today. You have consistently said that the Fed does not consider politics in making decisions. With a possible September rate cut on the table, it would be less than 2 months before the election, and former President Trump reportedly said that cutting rates so close to the election is something the central bank knows they shouldn't be doing. What's your response, and do you believe it's possible to really remain apolitical with a September rate cut?
I absolutely do, and I think it's, first of all, we haven't made any decisions. I would say it this way. Haven't made any decision about any future meeting. I don't know what the data will reveal or how that will affect the appropriate path of our policy. I really don't know. I do know how we will make that assessment. That's what I do know. So if you take a step back, the current situation, again, is inflation has come down much closer to our goal, and that's happened while unemployment has remained low. We're very tightly focused on using our tools to try to foster that state of affairs continuing. That's at each of our meetings and all of our decisions, our focus is strictly on that and really on nothing else, doing our part, whatever that part may be. We're using our best thinking. We're doing our best to understand the economy. We follow academics. We follow the many commentators who bless us with their commentary. But we to conduct our business in a non-political way at all times, not just some of the time. I'll say this too. We never use our tools to support or oppose a political party, a politician, or any political outcome. The bottom line is, if we do, we'll have price stability, people will find jobs, wages will rise in real terms, everyone will benefit. So that's what we believe, and that's how we will always act. This is my 4th presidential election at the Fed. I can tell you this is how we think about it. This is what we do. So anything that we do before, during, or after the election will be based on the data, the outlook, and the balance of risks, and not on anything else.
Just a quick follow-up. Do your economic forecasts and models take into account the two very different economic plans of these two presidential candidates, Harris and Trump? And if so, how?
No, we do not do that. We absolutely do not do that. We don't know who's going to win. We don't know what they're going to do. We don't act as though we know, and we just can't do that. You know, we basically, we have our forecast. We can run simulations of different potential policies, but we would never try to make policy decisions based on the outcome of an election that hasn't happened yet. That would just be a line we would never cross. You know, we're a non-political agency. We don't want to be involved in politics in any way, so we wouldn't do that.
Nicholas.
Thank you, Chair Powell. Nicholas Jasinski from Barron's Magazine. There hasn't been a dissenting vote on an interest rate decision in some time. If the data do evolve as you expect, if you do have more confidence by the September meeting, do you get the sense that there will be a unanimous vote on an interest rate move in September? Or basically, are there meaningful differences in committee members' assessments of how much more confidence is needed?
So there are always meaningful differences. There are, and you know, we talk a lot before, during, and after the meeting. We do have a very robust discussion of these things. You're right that in most cases, people, if they feel heard and they feel that their position has been given serious consideration, for most people, most of the time, that's going to be enough. There are dissents. That's fine. You know, no one has a veto. No single person has a veto. So it just is a question of who will vote for and against. We've had dissents. We haven't had so many during the pandemic era, and it just may be that, you know, we've felt more united because we felt, you know, under a lot of pressure to get things right. But before the pandemic, we had plenty of dissents, and dissents happen. It's part of the process. There's nothing wrong with dissents, and if it happens, it happens.
Jean.
Hello, Jean Young with M&I Market News. Is a 50 basis point cut as a first cut at all likely or even on the table? Thank you.
You know, I don't want to say, I don't want to be really specific about what we're going to do, but that's not something we're thinking about right now.
Jennifer.
Of course, I haven't made any decisions at all as of today.
Thank you, Chair Bell. Jennifer Schonberger with Yahoo Finance. Not to get into the minutes, but you said there was a real discussion today for moving at this meeting. I'm curious if you could provide some more color on the nature of the discussion today at the meeting about a possible rate cut as early as September.
Well, so, you know, the way the meeting is set up, the first day there's a discussion of financial stability because it's every other meeting we have that. And then we have an opportunity to comment on that. Then we have an economic go around. And then this morning we have the monetary policy go around. And I think in people's economic go around and in their monetary policy go around, people express their views about this. And there's a range of views. People, as you will know from the speeches that they give, people have different ways of thinking about the economy. And so, in the minutes, we'll lay this out in a much better way than I can do off the cuff. But there's a range of perspectives, and but I do think that we're a consensus-driven organization. People come together. This was a unanimous decision, and at the end, everyone supported the outcome, not just the voters, but everyone. So I would also say some people examined the possibility, the case for moving at this meeting, but overwhelmingly the sense of the committee was not at this meeting, but as soon as the next meeting, depending on how the data come in.
But there is a growing sense of confidence that you could move at the next meeting, assuming inflation comes.
Well, assuming that the totality of the data supports such an outcome, no question that is the case. That as I mentioned, we think that the time is it's approaching, and if we do get the data that we hope we get, then a reduction in our policy rate could be on the table at the September meeting.
Hi, Chair Powell, Nancy Marshall-Genzer with Marketplace. Former New York President Bill Dudley wrote an op-ed in Bloomberg earlier this month, which you probably saw, in which he said, quote, "It might already be too late to fend off a recession by cutting rates. Dawdling now unnecessarily increases the risk." Is he wrong?
So this is the judgment that we have to make, and we're well aware of the judgment. We're as I've said, we have to weigh the risk of going too soon against the risk of going too late. If we go too soon, we can, we had a lot of advice, to go ahead and cut after the 7 good months of last year. We didn't. We said we needed to see more. Then we saw some higher inflation. We've seen 1 quarter of good inflation, and we've seen the labor.
Communications, and some Fed officials said maybe the Fed wasn't as clear enough about its reaction function. And when I talk to the commentators who bless you with their comments, they say that they really don't have a sense of what is going to judge, maybe not the first cut, but the pace of the cuts going forward. They don't have a good sense of that.
Hey, folks, I hope you can hear the video. I got my stuff running again. It looks like internet went out in the office. So as long as you can hear Powell, I think we're okay.
I think the reality is that forecasters, and this isn't just the Fed by any means, forecasters have been continually surprised by, for example, the strength of the economy last year. So I think we had to be pretty humble about giving forward guidance about this, that, and the other thing. We need to be pretty careful about that. And, when you're saying you're going to be data driven, of course, it's always what the data, how they affect the outlook and the balance of risks, but nobody has great vision deep into the future. In terms of a reaction function, that's a long time, discussion that people have had forever. I think people have understood for a long time, actually, that we were very focused on bringing down inflation. Nobody was really confused about that. The data have, again, you've seen significant improvement in inflation just for the last quarter. Markets move around on the data, really, not so much. It's not really what we're going to do. It's more just that the data keep coming in, and markets are very, very responsive to that data right now.
Go to Jeff for the last question.
Thank you, Mr. Chairman. I'm going to change gears on you just a little bit from all of the rate talk and whatnot. With Fed now being in the books for a little over a year, there hasn't been a whole lot of talk about central bank digital currency, and wondering if you could give us an update on where things are with that. Is that considered a dead issue now? Is it still something that's being discussed within the committee, and what's happening with that?
It's not something that comes up at all in the FOMC. So more broadly, digital finance is an area that has really significant implications for payments generally, instant payments, and it's something that's going to really change the way it's going to make more efficient and hopefully safer and all those things the way payments are made around the world. And so we have people who are researching that and trying to keep up to speed, because we play an important role in the payments sector, both as a convener and as an operator too. In terms of a CBDC, there's really nothing new going on. There's not much going on at all. We don't have the authority to issue a retail CBDC that's available to the public. We're not seeking that authority. So what we're doing is keeping up with developments there. Pretty much every major central bank in the world is at least doing that. Some of them are actually seriously looking at implementing a CBDC. We're really not. We're really just evaluating, the story and what's happening out there. I think it's work that we need to be doing which could be very beneficial down the road. But we don't have on a CBDC. We don't have any plan to. We would need to go to Congress, and we have no plan to do that. No one here has decided that we think it's a good idea yet. Thank you.
All right, folks, that was good timing. It looks like Powell's done talking, so our stuff was exploding all around us. We've been live for 7 hours, so our PCs finally gave out and the internet finally decided to die. So thanks, guys, for watching. 7 hours. We had a lot of great guests on. Make sure to go through the chat. I think their links are still in there. Check out Chris Pulver. We had Forex James. We had Diego. We had Nick Phillips. We had Tom from Simply Forex on here. A lot of great people coming on and helping us out. So thanks, guys, for watching, and we'll see y'all next time.
Thanks for tuning in to today's A1 Trading Show. Make sure to subscribe and to turn on post notifications so you don't miss the next one. Also, we're looking for more guests to come on the show. If you're comfortable being on camera, have trading experience, and you're looking to grow your audience exposure, we'd love to have you on. In the live stream chat and description below, we'll drop a link to apply to be a live stream guest and join in on the conversation. We hope to have you on soon. That's all for today. Trade safe, and we'll see you next time.